Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 25th of April 2021. Last week one of our viewers had a question about whether housing and stocks are in a bubble. Now we all know that all speculative bubbles end in a crash, but that got me thinking, are these assets actually in a bubble to start with? In a speculative bubble, price far exceeds the intrinsic value for a particular asset. But how do we determine the intrinsic value of an asset? Considering factors such as supply and demand, net present value and PE ratios can help, but actually they don't tell us the whole story. The problem here is that there's a currency component to valuation, and fiat currencies themselves don't have a fixed valuation over time. Therefore, although intrinsic value of a stock may be stable, and even if there's agreement by the market participants on that value, the price of the asset will rise as the value of the currency that it's valued in falls. And then basically this makes things very confusing. Here's a chart of the Nasdaq index. And here you can see the dotcom bubble of the year 2000 over here. And it actually doesn't look too bad, does it, on this chart? I mean, at the time it probably looked massive, but this looks like a little blip really compared to this price action that we've had over here. This index has clearly gone sky high. But how much higher can it go? Now, on the face of it, this looks like a giant bubble, doesn't it? But the thing is, this doesn't give you the true picture of what's actually going on. This is the chart showing the purchasing power of the US dollar over the same timescale as the previous chart. And according to this, the purchasing power of the US dollar has more than halved. So the Nasdaq has still gone up much higher than the loss of purchasing power of the dollar, of course. But the problem is that this valuation of the dollar is based using the CPI. And as most of us here probably agree, that using the CPI won't really give us an accurate picture. If we inflation adjusted the Nasdaq chart, it would still look like a big fat bubble. An alternative way of looking at it is to remove the whole currency component. And so this chart shows the Buffett indicator, which is the ratio of the composite market value to GDP. Well, by this metric, basically stock valuations here are higher than they have ever been, certainly over this timescale since 1950. The problem I have with this metric is the use of GDP over here. So GDP stands for gross domestic product, but as discussed in my video on fast money, this parameter is prone to being fudged and is just as likely to be distorted as the CPI is. So I don't know, I just don't trust that as a metric. Another way of looking at it is to look at the stock price to earnings ratio. So this is the Shiller PE ratio chart. And this gives us a different picture to the last one. Currently, the value is 37.4. And, well, you can see that this is actually lower than the high of 44 that was achieved in the year 2000. Interestingly, this value was back in 2008, just before the crash then, the value only reached 27 over here. And we're well above that right now. So look, although a crash is possible at the current levels, remember that there's also further upside potential over here. In fact, who's to say that we don't actually exceed this peak here? I mean, if we look back to 1929, it took decades, but actually that peak was exceeded. I mean, could that peak be exceeded? There's no reason why not. Okay, what if we used the money supply to value these things? So in orange, we've got the S&P 500, and in black is the S&P 500 divided by the M2 money supply. Strangely, this chart suggests that stocks are in less of a bubble than they were back here in the year 2000. Isn't that interesting? It'll be even more interesting if we could get a chart like this that goes back 150 years. That'd be most instructive, I think. This chart shows the total market cap of the stock market for various countries in relation to their respective M2 money supplies. So in orange here is the USA, red is the UK, grey is Japan, black is France, and in blue is Germany. Now, except for Japan, all the countries are in less of a bubble than they were in the year 2000. Interesting. And also interesting is that the US stock market is more overvalued than those of the other countries by this metric. This chart shows the S&P 500 divided by the DXY. So that's the US dollar index. Yeah, this is an interesting chart, isn't it? This suggests a bubble. How can we interpret this? Well, my interpretation is that this suggests that the S&P 500 is very overvalued relative to dollar strength. How about using the US debt to make these kind of valuations? So here we've got the S&P 500 divided by the total public debt in USA. And again, this chart shows that we are here, and this is in less of a bubble than, guess what, the year 2000. And actually, we're even in less of a bubble than we were in 2007. Isn't that interesting? And of course, we can't do this without looking at gold. So this chart shows the S&P 500 to gold ratio going all the way back to 1890. And again, we can see that the S&P 500, when priced in gold, is nowhere near as overvalued as it was in the year 2000. Let's move on to housing. And certainly, shown on this chart, the gains have been pretty strong, and certainly here in New Zealand, real estate prices have reached eye-watering levels. And, you know, of course, it's quite natural to think, how much more can prices rise? I mean, wages aren't rising particularly fast, and yet house prices are just steaming upwards. Well, let's do the same thing that we did with stocks and look at different ratios. So this chart shows the house price to M2 money stock ratio. You can see that this is the complete opposite of the previous chart. It's on a complete downtrend, which is slightly bizarre. I wasn't expecting that. So according to this, although housing may seem overvalued in US dollar terms, they're actually undervalued in money supply terms. Now, one criticism of this chart might be that, well, look, the population's grown over that time, so maybe this isn't a true picture. Well, this chart is the same chart, but I've adjusted it for the size of the population. And according to this, the real estate bubble actually peaked here in 2005, and currently it's the lowest it's been in 40 years. What if we used the total public debt? Again, not a bubble. It was more of a bubble back here in the 2000 to 2005 time. Finally, what about housing priced in gold? Well, according to this metric, the housing bubble peaked here, which occurred in the year 2000. That year seems to come up a lot, doesn't it? Look, in conclusion, we know that valuation is actually a tricky thing, more tricky than people realise. And here I've just been playing around with different metrics to try and look at the subject of valuation from different angles. And I actually found the results were actually quite unexpected. So thanks to our viewer for bringing up this topic. It's been quite an eye-opener. The loss of purchasing power of currencies is actually very difficult to quantify, and yet it can have a profound effect on how assets are priced. The data shown here leans more towards stock and housing being in less of a bubble than they were in the year 2000s. Look, I don't know when stocks and houses will crash, but the data shown here suggests that further upside is entirely possible. Next up, the market update. Let's start with gold price in US dollars, and this time we'll look on the monthly scale. Now, of course, this candle hasn't completed yet. We've still got another week, but it's looking good. Nice green candle. But look, it's still early days yet. The reason I wanted to look at this chart was just to have another look back at our sentiment, going back to that video that I spoke about. And one of the quotes that I gave previously was how bull markets begin on pessimism, they grow on skepticism, and they end on euphoria. And so certainly between kind of here and here, there was a huge amount of pessimism. It could be said, I mean, this was the very bottom of the gold price, so it could be said that the bull market started here. Others say that it started here. But look, we know that over this time, during this bottoming process, there was a lot of pessimism around at the time. And as price was moving up, people were skeptical of it. And, you know, I remember I was very skeptical of it, and I kept thinking, oh, it's just going to retrace and come back. And it never really did. Instead, it charged up with some pauses over here like this as well. And of course, we had that rapid, very brief drop over here back in March last year. But I remember this move here, it was fast and it was large, and there was a lot of euphoria occurring around that time. Now, these sentiments can occur on multiple timescales and of different magnitudes. And so if we're talking about this being a kind of secondary bear market, it's been less than a year, and let's say that this was the bottom. I don't know for sure yet. Nobody knows until well, we'll talk about that in a moment. But look, let's just work on the assumption that that was the bottom, and certainly there was a lot of pessimism around there. As price moves up, there does seem to be a fair amount of skepticism. Let's move on to gold price in US dollars on the daily scale, and this is the skepticism during this move that I'm talking about. And I think we're going to get skepticism probably up until we pass through this level here, which is about 1870-ish. But even then, I don't think we're going to reach optimism until we surpass this high. And so really the question is, at what point, because the thing is, you can argue at any point, oh, but price could just turn around. That can occur any time in a bull market. And so the question is, at what point do you decide you're confident enough to jump in and you think that the trend has begun? And the thing is, it's interesting because you'll get a different answer with different people. Everyone will have different kind of risk tolerances and different levels of confidence. So, you know, some might have seen this low here and thought, look, it's touched that trend line, I'm going to go for it. And others may have waited for this and saw the bounce up and may have moved in over here. Others may have waited for the breakout for this, what looks like a double bottom. And so they would have bought in at this point here. And price has still moved up. But then, you know, you could say, well, you know, we're still in this channel. Well, who's to say it's not going to move down here and touch the trend line yet again? And look, that is absolutely a possibility. And, you know, we can't discount that. And really, we just have to work with various, you know, methods that you've got, look at the fundamentals, but there's no guarantees with any of this. So to be confident of that not happening, then the next point would be to go through this upper trend line. And at that point, you could be confident, some would say. But then, you know, price could just move up a little bit before moving down again. That's a possibility. So some might say, well, you need to have a new all-time high to feel confident that this bull trend has begun. But then you see, by the time you get up here, you know, you've missed this move here. That's, you know, over $300. And so, you know, price could go up here and we don't know when it's going to turn around. And so let's say it went to, just arbitrarily, say it went to 2,200, peaked there and then came back down. Well, you've only captured a small percentage of that move, even if you caught the absolute top. So look, this isn't an easy thing, but that's one of the things you've got to think about. At what point would you feel confident? Okay, anyway, so as I said, we're still in this channel. We are still in this short-term uptrend here, so that hasn't broken either. So yeah, I'm still feeling positive. Now, sometimes if this is the double bottom, then what can happen once it breaks out, which it has done so, it can go back and retest that point. So potential for a little bit lower price, but you know, not a huge drop I wouldn't expect, before resuming its upwards move. But yeah, it's getting a bit nail biting, isn't it? I was hoping for a nice strong end to the week, but it's just been kind of teetering with a bit of indecision over there. Let's move on to silver priced in US dollars on the daily scale. And again, this is moving along quite nicely. I'm pretty happy with it. So remember, we think that this is a descending wedge, which is a bullish pattern. Price has broken out of that. It retested it twice before price moved upwards, and it's moving up quite an orderly fashion in this channel. And so downside potentially to about 25.50 if it does move down. It's kind of hanging around this 26 level, so it's kind of going above and below it. And that's a similar thing happened back over here as well. That is an important level there. So if we can go above it and, you know, if that acts as support, that's what we're hoping for. Look, I still think the target here is 30. And I think that, you know, we're still getting higher lows here. So I don't think we're going to go below this $24 level. Well, below this candle. Yeah, so I just don't think we're gonna go back down there. And next we have the gold miners. So this is GDX on the daily scale. And this is the line joining these two highs here, and it's pretty clear we've broken out here. And in fact, we've broken out and then price has come back to retest this line before moving, well, I'm assuming, yeah, but yeah, this could move upwards. That's what I think is going to happen. I don't think we're going to go below this low here. And this is still looking pretty bullish here. So we've got quite a big target coming up above here, and we're kind of looking at above 50 in the longer term, but obviously it's going to take a bit of time to get there. But look, this is broken out. There's no arguing that really. And so I think we've got some nice moves ahead for the miners in the coming months. If we look at how the miners are performing relative to gold on the daily scale, and again, that's broken out as well. So what this is showing is that the miners are outperforming gold. And again, I would expect that to continue. So that's good news, hopefully. And finally, we've got the silver miners. So this is the SILJ on the daily scale. And yeah, there's not much new to say here. You must be getting a bit bored of me saying the same thing. But look, I still think this is positive. We seem to have formed another kind of little channel over here. And this is still looking positive to me. What we're hoping for is, well, we're really looking for a breakout above $17.50, and then, and only then, really will we be likely to be off to the races. Now, why do I say that? Well, if we look on the monthly scale, we've had this compressing kind of pattern over here, and you'll notice that we got a big bounce off of this trend line over here, and yet again here. But over here, I mean, it briefly pierced it. I mean, that could be said that it was a bit of an anomaly because of all the, you know, all the action that occurred back in February. But the other thing is that price is kind of bunched up here. It's not like it went up there and just bounced back down again. It's hanging around there. It looks like it wants to stay there. And, you know, if you look at this bottom trend line, it spent very little time down here. These are long wicks. So it seems to me like it likes this end of the chart more than this end of the chart. And yeah, as I said last time, this could be a flagpole, in which case, you know, we could have a little flag here. And then the breakout would be quite a high target. So yeah, as you can guess, I'm still bullish, but look, I know there's still skepticism out there, and rightly so. We don't know what for sure, but you know, that's the way I'm looking at things. Now it seems like the scammers have discovered my channel. It's so annoying. So you know, when you comment, if you get what looks like me, unless there's a little black bubble around the title, just ignore it. Look, I'm not going to be dishing out my phone number, and you know, I don't have a personal assistant, which all these scamming emails and scamming comments seem to say, and tell you to call my assistant. That's all rubbish. Just either ignore it or report it, but yeah, don't reply to them, and certainly don't phone them up. But yeah, it's bizarre. Those things seem to be absolutely everywhere, and you'd think, you know, with all this AI and high technology and, you know, all this fancy software and stuff, that, you know, the famous algorithm would be able to sort that out. But clearly not. Anyway, so I don't want any of you to get burnt with any of that. Don't forget to like and subscribe, and we'll see you next week. Bye.